Hey everybody, it's Ken McElroy here, and so today we're going to talk about real estate versus stocks, and there is no better time to talk about this right now because real estate's taking it in the eye and stocks are taking it in the eye, and of course you can see my eye. So let's jump right into it. This is a very common scenario of the people that take the real estate path and the people that take the stock path. This path here for stocks requires very, very little interaction. It's super passive. This requires a lot of thinking, a lot of personal development, a lot of education, and is very active. There are two different paths, and they have two very, very different outcomes. So the first thing that I really like about real estate versus stocks is real estate is what I would call an imperfect market, and stocks is more of a perfect market. In other words, you can make money in stocks, there's no question. You know, I'm not a day trader, and that scares the heck out of me just because I don't understand it. But you can buy something and sell it for higher. You know, you can do that if you really understand what you're doing. But it is very much a perfect market. There's millions and millions of people in there, and you're not going to get a deal, let's say on Amazon or Apple stock. You're just not going to. There's no value add in stock. You basically come in and hopefully at a low point and sell at a high point. Now there's taxes and things associated with that because that's a capital gain, short-term income issue. But we'll get into that later. But it's a perfect market. So you enter and then you exit, and hopefully you time things well. I think it's very, very difficult to manage stocks personally. And I know a lot of people would disagree with me, but I've never been very successful with it, and I don't know a lot of people that are successful with it. In fact, I think that the reason they started bulking up these mutual funds and all these other things is to even complicate it even more. And the one thing I love about a real estate market is that it is the imperfect market. And so just like a lot of things. So as you guys bumble along and you go to, let's say, a garage sale and you find something that is not worth very much, and then you go on the internet and you see it's worth a lot, that's an imperfect market. Or the same thing with a car. Let's say you find a car that somebody just puts on there, they're trying to get rid of, maybe they're going through a divorce or there's a death or something, and they're just trying to move things. You might be able to get a car for half of what it's worth, and so you buy it, and you immediately, if you sold it, you would make some money. That's what I call an imperfect market. And we do that in real estate all the time. And so the reason why I love an imperfect market is because we can buy real estate at significantly less than the house next door and then do a value add. And this is what I would call an imperfect market. So in real estate, you make your money when you buy. So what you have here is you have the opportunity to be able to buy something and then create value. So in our case, you know, we add washers and dryers, for an example, and we charge another $50 a month. Or we do an interior upgrades on the inside, which might cost us a couple $1,000s with flooring and appliances, etc. And then we increase the rents $100 a month. Those are called value add strategies. You can't do that with the stock in a perfect market the way it is. In addition to that, both stocks and real estate do go up and down with the market. So in that way that they're very similar. And so right now, as you guys know, we were in a bubble on real estate and we were in a bubble in stocks. And so in that way, from a capital gain standpoint and from a value add standpoint, they're very similar. But on a value add standpoint, they're not similar at all. So you can force equity from an imperfect market scenario. When you buy a house at $200,000, you can renovate it and you can make it worth $250,000, and you've increased the value by $50,000. So it's very different than this, and so you can essentially force equity through hard work and vision that you see, and you just can't do that in a perfect market. That's the first thing that I love about real estate, and I think it has a significant advantage over stock. The second thing is the difference between liquidity and non-liquidity. And in this case, there's no question that stock wins hands down. So real estate is not liquid. It is not something that you can sell right away. Typically, you've got a lender involved, sometimes you have investors involved, and there's a longer time frame when real estate gets sold. Like with a stock, you can literally get up in the morning on your cell phone and sell that stock, if it's at a high and you bought it at a low, and you can make money from that right away. So this is a massive difference. Real estate is not liquid, stocks are liquid. And you can get out of stock quickly if things are going bad. And so that is a massive advantage that stocks have over real estate for sure. But the difference here is, for me, I'm investing for the long term. I'm not trying to time the market on a short-term basis. If everything's going down and the real estate market's going down and the stock market's going down, then stocks win by a long shot and have a massive advantage over real estate in this particular area. So in the third scenario, which I love, we're going to talk about the difference between leverage and margin. So in real estate, you can actually get leverage. So you're going to use other people's money. So you can use equity and debt. In other words, let's say you find a $200,000 piece of property, you take it to the bank and they say, you know, we'll give you 75 or 80%, and then you either have the money or you don't have the money. And if you don't have the money, then you can syndicate or go out to a group of investors and still do that deal. And the bank takes the property as collateral. So in this particular case, you're actually controlling the investment. You're buying what you want. You're making sure that it cash flows. Maybe it's a value add, but you're actually managing your money actively. In this particular case, typically on a margin, you can borrow against your stocks. And it's true that you can also borrow your money that you actually invested into stocks and then perhaps even margin off of that. But it's a lot more risky here. And by the way, these margins, they can do really well going up, but it can also do really bad going down. And in the real estate world, equity goes up and it goes down, and values go up and they go down. But if you're cash flowing, you're going to be fine long term. But the best thing is, in my opinion, is that you can leverage 100% of other people's money. As long as it cash flows and it's paying everybody, everybody's going to be happy. In this particular case with real estate, you have more control than you do in the stock scenario when you take a look at margin and you take a look at leverage. The other thing is, in real estate, the banks actually look at the collateral. So in other words, they look at that $200,000 house as their collateral. So if you mess up and you can't pay the payment, then the bank gets that money back. Now they have reduced their risk with that loan that they've given you, because they can take that property back and they can sell it later and recover the cost of that loan that they give to you. So the collateral is a big piece in the stocks versus real estate. So in this scenario here, stocks versus margin, real estate wins by a long shot for all of those reasons. Also, you don't need any money of your own to start. So let's look at number 4 now. So this is my favorite chart by a long shot. The tax advantages versus what I call the no tax advantages for stock. Now, there aren't very many, and if you really get technical, as a stock person, you can find a few. But there's no way that stocks even come close to the tax advantages, and you can do it through real estate. And you can do it through 2 primary things, although there's many others. The first one is depreciation, and the other one is a refinance. Depreciation is actually a non-operating expense after cash flow. You can have income and you can report a tax loss with depreciation. The other thing that I love here on the refinance, when we talk about these value add strategies, you take that $200,000 home and you grow the value to $250,000 through some kind of value add strategy, or maybe the market helps you. You can go back to the bank and get another loan and do a cash out refinance, which is also tax-free. It's tax-free because it's debt. You actually owe it back, so it's not considered income. These are great ways to be able to harvest cash in real estate, and this is primarily why people do it. They get their money to work for themselves, and they grow the value of the asset, and then they refinance, and they use depreciation, and the whole time, legally, it's all tax-free. So if you actually end up selling the property, then all that tax-free stuff that you got was deferred up to that point, and then you have to pay it, which is why primarily real estate folks don't like to sell, because you have depreciation recapture and you have all these things from all these tax-free things that you were able to do. They were all deferred up to that point. So that's why we like to hold real estate long term, and we like them to grow, and then we like to harvest it with refinances. So you just harvest through cash out refinance, and you keep taking that cash flow out tax-free because of depreciation. But if you sell, it's over. So now let's look at number 5. So obviously we talk a lot about cash flow versus no cash flow, and I'm not going to get into cash flow versus capital gains, but largely stocks are based on a capital gains strategy. In other words, you buy them at one price and you sell them for a higher price. In real estate, people do that. They buy something at one price and they try to sell it at a higher price. So in that particular scenario, they're no different. In other words, if you're a flipper, you're basically playing the stock market with real estate. Okay, but that's not what we do. We buy for cash flow, we buy for financial freedom and for the long term, and we like to take advantage of all the tax strategies and all the things that we can do that real estate has to offer over the long term. And to be quite honest, I want to be in a situation when we have a lockdown or a quarantine or whatever it might be, where I have enough cash flow coming in so that I'm not reliant on some other source of income like a job or a commission or something like that. And that's the entire point here. So cash flow with real estate has a massive advantage if you do it correctly. And all over YouTube, there's all kinds of really good strategies and scenarios from all kinds of people that tell you how to buy positive cash flow properties. And that is exactly what you guys should be doing, is you should be trying to find these cash flow positive properties. But the tax-free cash flow is the massive advantage that real estate has. Of course, this is tax deferred year over year over year, and then you recognize it if you do sell, or you could take advantage of all the tax benefits that you have and then do a 1031 into something bigger and keep it going for years and years and years and years and years and years. So for me, everything that I own that cash flows is not on the market. If you get enough cash flowing properties, then you're going to become financially free for the rest of your life. And the only reason that you wouldn't be is if you sell them all and then you got to pay all that tax back and then you got to go reinvest it again, because what are you going to do? You stick your money back in the bank or in the stock market again, and then you're going to have to refind it again. So number 6, this has to do with control. Now, the one thing that you do not have when you turn your money over to someone else or you invest in the stock market is you really don't know which way it's going to go. And the truth is, in real estate, it can be that way too. But in real estate, you have more control because, as I said earlier, if you buy in an imperfect market, you can buy something and value add it. And over time, the tenants are paying down your debt. Those are for sure. So if you put a loan on something and you have an 8 or 10 unit property and those tenants are paying you and you're using that money to pay down your mortgage, you're growing your equity. If you're putting money back into the property and rents are going up over time, you're growing the value of that property and you're in control of that. In stocks, you have very little control and you're much more removed from the actual operations of that investment itself. So the winner here is in real estate, you can directly manage your own investments. In stocks, you cannot. But number 7 has to do with passive versus active, and there's no question real estate is active. Real estate takes management. You have to sign leases, you have to show your places, you have to coordinate contractors, you have to collect the rent, you have to pay a bank. There's a lot of moving parts here, and in stocks, there's none. You basically give your money to somebody and you hope that it goes up, or you invest it yourself and you watch it and you hope that it goes up. In most cases with most people, they turn their money over to some financial planner or some wealth manager, and this is all taken care of for them. And they hope toward the end of their retirement that there's enough for them to live on. That is basically what everybody does. And so it's a massive difference. In this particular case, in the active, you actually take an active role in your financial future. In this one, you basically turn it over to someone else. So it's just a decision and a choice of whatever it is you want to do. So let's look at the last one in number 8. So this is asset protection versus no asset protection. So basically, these are entities and insurance. So on the real estate side, I had a property, for example, in Houston, Texas, that actually had a large fire. And so the insurance kicked in, and the insurance company paid for my rent loss. They paid to fix the property. I got a brand new property. The property was built in the 80s. And so we had this beautiful property, and they paid for my rent loss while we were fixing it and before we could re-rent it again. All covered by insurance, all paid by the property. That is asset protection. So in the beginning of this video, I started to talk to you about the choices and the 2 paths. And so now you have the same choice. Do you want to turn your money over to someone else and hope that it does well over time? Or do you want to take a path of where it's going to require a little bit of personal development, a little bit of financial education to be able to, in my opinion, have a little more certainty and a little more control over your financial future that hit the goals for you for when you're retired? So that's the choice. Do you want to be active in your own management of your own money and your own wealth over a long period of time? Or do you want to be passive? It's really your choice. Thanks for listening.